To talk more about the conflicts and currencies ahead of the G20, I'm joined by Robert Minikin. He's senior forex strategist from Standard Chartered Bank in Hong Kong. Thanks very much for joining us, Robert. So, Tim Geithner there talking about the yuan, but if we want to talk about the dollar, that's obviously fallen quite a bit, and it's set to go even lower, isn't it? Because the U.S. is just about to print more money.
Well, I think we need to be a little bit careful about market positioning. The market itself is quite short US dollars, at least that's what the futures data suggests. But also I think we're seeing a more vigorous approach from central banks to try and contain currency volatility. And of course, that was demonstrated by the Brazilian move overnight, but also some of the steps that we're seeing here in Asia in terms of withholding tax changes and other changes to manage FX markets.
But those kind of moves just escalate the currency war, Robert. I mean, is there any hope that global leaders, when they get together at the G20, will be able to stop it?
I think this talk of currency wars is an over-dramatization of the situation. I think the G20 leaders for a long time have held the view that some currency move is required in order to trim global imbalances. So the type of moves that we're seeing in FX markets is actually functional. Currencies in general are moving in the right direction to even out global trade imbalances.
Is it right for the euro, for example, to be moving as high as it has?
I think we need to be cautious on the euro move. We actually have a forecast of 140 for the end of the year for euro dollar, but then the euro loses some of those gains next year. It's important to note that there are areas of weakness in the eurozone economy as well as in the United States economy, and of course some of the issues around sovereign debt problems, those Greece, Spain, etc. Those issues are still there. So I think certainly investors need to be cautious about investing in holding euros at these levels.
Well, what happens when the high value of the euro, the high value of the yen actually begin to damage these economies? I mean, could we see a double dip in those places?
Well, it's not our central view that we'll see a double dip, and there are a couple of reasons for that. Firstly, at Standard Chartered Bank, we've long argued that we'd see new quantitative easing steps in the United States, and of course we're seeing similar moves in Japan. But also there's quite a lot of momentum in economies outside of G10, of course, particularly here in Asia. So we think that we may be in for a period of somewhat moderating growth, but no double dip.
So, Robert, very quickly, is this second round of QE, if we do get it from the Fed, is that going to work and actually end up boosting the dollar in the end?
I think that the important thing to note in terms of currency markets is that the levels that we've reached, just for example on the Aussie dollar pushing up to parity over the last couple of days, many of the currencies we're looking at are pretty overvalued now against the US dollar. And when ultimately we start to see better economic readings in the United States, you know, we could well see a significant dollar bounce.
Thank you very much.